You see a company's revenue soaring and feel a rush of excitement. But what if I told you that to a chief financial officer, that same number can be a huge red flag? While everyone else stares at the top line, smart investors dig into the cash. They live by the motto, revenue is vanity, profit is sanity, but cash is king. Today, I'm showing you how to read financial statements like a CFO to spot potential 10x stocks. We'll skip the surface level noise and use two critical metrics that show the real health and explosive potential of a business. Section 1, the revenue trap. A headline screams, company revenue grew 50% year over year, and you think this is the one. But a CFO is trained to be skeptical. They know a massive revenue number can hide ugly problems. How? Because a sale recorded on the income statement doesn't mean cash is in the bank. A company can offer generous payment terms, making today's revenue look fantastic, but creating a cash flow nightmare for tomorrow. They might look like a rocket ship on the income statement, but their cash flow statement tells the story of a company running on fumes. Revenue is the promise of money. Cash is the money itself. A professional doesn't just care how much a company sells. They are obsessed with how efficiently it turns business into cash. Section 2, the CFO's secret weapon, the cash conversion cycle, CC. The cash conversion cycle, or CCC, measures the time in days it takes for a company to convert spending on inventory back into cash from a sale. A shorter cycle is always better. The formula is DO. That's days inventory outstanding plus days sales outstanding minus days payable outstanding. You want the first two numbers low and the last one high. When you can collect cash from customers before you have to pay your suppliers, you get a negative cash conversion cycle. This means the company is using its suppliers' money, interest-free, to fund its growth. Amazon has run a negative CCC for years. They take your money instantly, but take their time paying suppliers. That gap is pure cash they use to build and innovate. A consistently low or negative CCC is a huge green flag. It tells you the business is incredibly efficient and has a powerful market position. All right, we just broke down a concept that flies under the radar. If you're finding this valuable, hit that subscribe button. We're about to go deeper with the single most important metric for finding high-growth stocks. Section 3, the ultimate metric, free cash flow. If the CCC tells you how efficiently a company generates cash, then free cash flow, FCF, tells you how much cash it generates. It's the money left over after a company pays for all operations and big investments. This is the free cash management can use to pay down debt, pay dividends, buy back stock, or, most importantly for us, invest in huge growth projects. The formula is simple. Free cash flow, cash from operations, capital expenditures. You can find both on the statement of cash flows. And unlike net income, which can be manipulated, FCF is much harder to fake. A company with weak or negative FCF is just trying to survive. Look at Nvidia. Its monster growth is credited to the AI boom, but a CFO would point to its staggering free cash flow. That gives it the power to pour billions into R&D to stay light years ahead. A positive and growing FCF is one of the best signs of a healthy, sustainable business. Section 4, connecting the dots to 10x stocks. How do these metrics lead to 10x stocks? It's about seeing a company's true power. A company with an amazing cash conversion cycle is a perfectly tuned engine. It runs with incredible efficiency and wastes nothing. A company with strong and growing free cash flow has the high-octane fuel for that engine. When you find a company that has both, an efficient cash-generating machine, low CCC, and a massive amount of fuel to reinvest for growth, high FCF, you have found a potential monster. It is a self-funding rocket ship. This is the exact profile of a business that can compound its value year after year, turning an early investment into a 10x return. The next time you're looking at an investment, think like a CFO. Look right past the headline revenue number. Pull up the financial statements and go straight to the statement of cash flows. Calculate the cash conversion cycle to see how efficient the business is. Then find the free cash flow to understand its real financial power. These two numbers will give you a far more accurate view of a company's health and potential than any revenue figure ever could. This is how you find incredible growth stories before they become common knowledge.